U.S. nat gas futures experienced a notable rise last week, closing at $2.72, up by almost +8%. This surge to a one-week high was primarily driven by forecasts of higher demand due to slightly cooler weather predictions and the gradual recovery of output following early January's Arctic freeze. As traders anticipate changes in weather conditions, this upswing reflects the market's sensitivity to both environmental factors and supply trends. Analysts anticipate notable fluctuations in natural gas demand, influenced by changing weather patterns. Initial projections suggest a decline in demand from the current 144 to 124 billion cubic feet per day in the lower 48 states by next week. Nevertheless, a subsequent increase to 127.8 billion cubic feet per day is foreseen within 2 weeks, coinciding with the onset of cooler weather. This variability in demand closely corresponds with meteorological forecasts, which indicate warmer than normal temperatures persisting until at least February 10, followed by a shift to cooler conditions in the week starting February 4. On the supply side, January's production in the lower 48 states averaged 103 billion cubic feet per day, a decrease from December's high of 108 billion. Working gas and storage was recorded at 2,856 billion cubic feet as of January 19, 2024, marking a net decrease of 326 billion from the previous week. Despite this drawdown, storage levels are still 110 billion cubic feet per day higher than last year and 142 billion cubic feet above the 5-year average, indicating a resilient supply buffer. The LNG export industry is gradually recovering from the recent severe cold spell. Gas flows to U.S. LNG export facilities averaged 13.8 billion cubic feet per day in January, a decrease from December's 14.7 billion cubic feet per day. Nevertheless, a rebound is in progress, and daily LNG feeds is anticipated to increase to around 14 billion cubic feet per day, marking a recovery from the one-year low of 9.2 billion observed during the freeze. Recent data from Baker Hughes shows an increase in U.S. drilling activity, with the oil and natural gas rig count rising by 1 to 621 in the week to January 26, 2024. Although this is a positive sign, the total count is still 19% below the same period last year, highlighting the industry's cautious stance in scaling up production. On Friday, the Biden administration halted the surge in U.S. gas exports, putting a pause on planned projects criticized by environmentalists as carbon mega-bombs. Pending LNG export permits are on hold until the Department of Energy establishes updated approval criteria addressing climate change impacts, potentially jeopardizing over a dozen planned Gulf of Mexico gas export terminals. Looking ahead, the weekly forecast for U.S. nat gas is bullish, underpinned by the expected rise in demand due to cooler weather and the ongoing recovery of LNG exports. However, the recent temporary halt on pending decisions for LNG exports by the Biden administration could exert downward pressure on natural gas prices this year. Throughout this period, the Department of Energy will assess the effects of LNG exports on energy costs, America's energy security, and climate change. Nevertheless, the market remains sensitive to fluctuations in weather forecasts and production levels. Traders will closely monitor these factors, as they will be key in determining the direction of nat gas prices in the upcoming weeks. From a weekly technical perspective, nat gas futures have failed to sustain above the 50-week moving average at $3.10, which has now become a new resistance level. The downward trend is anticipated to persist as long as prices remain below the 50-week moving average, and a retest of the January low at $2.40 is likely in the near term. Thank you for watching. Please don't forget to support the channel if you enjoyed the video. See you in the next one.